economist Willem Buiter has acted as consultant to the World Bank during a distinguished career as an economist. He's also been an advisor to the IMF and Goldman Sachs, was a founding member of the Bank of England Rates Committee and current member of the ECB Shadow Council. These days, he's chief economist at Citigroup. Willem Buiter joins me now from the bank's London office. Mr. Buiter, thank you so much for speaking to us. Good to see you. So, just talking there about the World Bank report, they lowered their forecast for the world economy this year to 3.2% because of Japan's earthquake, political unrest in the Middle East. And, I remember the last time you and I spoke just a couple of months ago, we were speaking about the level of uncertainty there is out there. Is the situation any better now?
Not really. I'm actually surprised that they only lowered the global forecast by 0.1% since half a year ago. I would have thought that a larger reduction in the forecast would be coming out of the pipeline this year. It's still reasonably optimistic. If we achieve these kind of growth rates, the outlook worldwide is not that bad at all, but I'm afraid that we'll probably end up undershooting that forecast for the rest of the year.
I mean, you say that it's very optimistic. How difficult is it going to be for developed countries, at least, to achieve these kinds of growth rates when unemployment is high, food and energy prices are rising, consumer spending not what it should be?
Any stimulus would have to come from a spontaneous recovery of animal spirits in the business sector, driving investment, private investment, and in the household sector, getting household consumption going. Of course, demand from emerging markets would also help, but there's no help going to be forthcoming at all anywhere in the advanced world from fiscal policy. All we're going to be seeing there at best is sitting still and more likely serious tightening. And of course, monetary policy is at the end of its tether with rates at zero and the Fed engaged, or rather almost at the end of its quantitative easing and not about to do anything more in that regard.
Mr. Buiter, if we can talk, sort of get region-specific, if you like now, what is your forecast for the Eurozone as a whole, particularly now as we start to see perhaps something of a clash between Germany and the ECB in the aftermath of Wolfgang Schäuble's letter to Euro finance ministers?
Well, I don't think that these kind of little spats matter that much. I think the Eurozone will continue to grow this year at probably just over 1.5% on average. What is more worrying is that it's very unevenly distributed within the Eurozone, with continuing strong growth in Germany and other core countries, and really pathetic growth or even negative growth in the European periphery, where the debt problems, the public debt problems, are accumulating and threatening to bring us to the edge of state insolvency in the near future.
I mean, I guess one thing that the spats, as you describe them, they sort of demonstrate the difficulty in trying to resolve at least this latest phase in Greece's debt crisis. Is some sort of restructuring or reprofiling pretty much inevitable now?
Well, what I think is ultimately inevitable is a serious, hard restructuring, a write-down of much of the Greek sovereign debt, but we're not there yet politically. What we're going to see first is what everybody else in the world would call maturity lengthening, but what will probably be described in Euroland as a rollover of some of the privately held Greek sovereign debt on a, quote, voluntary, unquote, basis. That satisfies the ECB and still gives the Germans their pound of flesh in terms of private sector burden sharing and bailing in. That's just a holding operation, of course. It's a liquidity management operation,
Mr. Buiter,
not a solvency gap.
Could this mean that sorry to interrupt you, does that mean that restructuring also could be on the cards for Ireland and Portugal? And are investors underestimating the extent of Spain's problems right now?
Well, I think one has to look at each country individually. Blind contagion should never be a problem if the monetary authorities and those managing the European facilities play their role. But yes, I think there is a high risk of deep sovereign debt restructuring also for Ireland and for Portugal. Spain still has the chance to keep its sovereign debt whole. They have to, however, I think, become more forthcoming about the likely additional losses in the banking sector and the likely hidden deficits in their sub-sovereign sectors at the autonomous regions and municipalities level. If they tackle these aggressively and with determination and with the necessary structural reforms, Spain should be in the clear. But there are a lot of preconditions for that to be satisfied.
Mr. Buiter, as I'm sure you're aware, we've got the OPEC meeting taking place at the moment in Vienna, and perhaps some differences emerging about where to go next. Perhaps unsurprisingly, Iran and Venezuela indicating that they are opposed to any raising of quotas. And yet we've had oil prices up, 37% in the last year. Is this something that developed countries are just going to have to accept and learn to deal with, having these external oil price shocks?
Yes, I think with the unpredictability of OPEC, on top of an underlying trend in oil prices, which I think is upwards, right, we are going to have to learn to live, to be at the receiving end of both erratic and, on average, uptrending real oil prices. That's going to be the future.
And do you think this is something that economies and consumers will continue dealing with, higher food and energy prices over the next year or so, particularly in the US?
Well, this is a worldwide problem, of course. The US is more energy intensive than most other advanced economies, so consumers and producers get hit more there. However, the US still produces half the oil it consumes, so it isn't all, a tax by OPEC. Domestic producers are better off, and provided they, spend out of the additional income, the demand consequences need not be as severe as they would look if you just look at the oil bill. But it certainly won't help the recovery.